Tapping into your home's equity can feel like easy money, but one wrong move could cost you thousands, or even put your home at risk. Are you borrowing for the right reasons, or just chasing short-term relief? In this video, we're breaking down the most common home equity loan mistakes people make and how to avoid them so you can protect your wealth, minimize risk, and make smarter decisions with one of your biggest financial assets. Avoid borrowing more than you truly need just because your home equity allows it. When lenders approve you for a home equity loan or line of credit, they often base it on your loan-to-value ratio, sometimes allowing you to borrow up to 80% or even 85% of your home's value. For example, if your home is worth $400,000 and you owe $200,000 on your mortgage, you might be approved to borrow up to $120,000 or more. But approval is not a recommendation. Borrowing the full amount, simply because it is available, can quickly turn into a financial burden. Every dollar you borrow accrues interest, and home equity loans typically have fixed rates that may range from 6% to 10%, depending on market conditions and your credit profile. If you borrow $100,000 at 8% over 15 years, you will pay over $43,000 in interest alone. That is a significant cost for money you may not have truly needed. Additionally, overborrowing reduces your financial flexibility and increases your monthly obligations, which can become dangerous if your income changes or unexpected expenses arise. A smarter approach is to calculate exactly what you need for a specific purpose, whether it is a $25,000 kitchen renovation or $15,000 in debt consolidation, and borrow only that amount. Treat your home equity as a limited resource, not a spending opportunity, because your home is ultimately on the line. Avoid using a home equity loan for short-term or depreciating expenses. It can be tempting to tap into your home equity for things like vacations, new furniture, or even a car, especially when interest rates on home equity loans are lower than credit cards. But this creates a mismatch between the life of the asset and the length of the debt. For instance, financing a $20,000 vacation with a 10-year home equity loan at 7% means you could still be paying for that trip long after the memories have faded, and you will end up paying thousands more in interest. Worse, you are turning unsecured consumer spending into debt secured by your home. If you default, the lender can pursue foreclosure, which is a much higher risk than missing a credit card payment. A better use of home equity is for investments that may add value or improve your financial position, such as home improvements, education, or consolidating high-interest debt with a clear payoff plan. Even then, caution is necessary. Before using home equity, ask yourself whether the purchase will provide lasting value or financial return over the life of the loan. If the answer is no, it is a strong sign that you should avoid using your home equity for that expense. Avoid ignoring the total cost of interest, fees, and closing costs. Many borrowers focus only on the monthly payment, which can make a home equity loan seem very affordable. However, the true cost includes origination fees, appraisal fees, title costs, and potentially annual maintenance fees if you are using a home equity line of credit. These upfront costs can range from 2% to 5% of the loan amount. On a $50,000 loan, that could mean $1,000 to $2,500 in fees before you even start paying interest. Then there is the long-term interest expense. A lower monthly payment often means a longer loan term, which increases the total interest paid. For example, stretching a loan from 10 years to 20 years may reduce your monthly payment from $600 to $400. But it could double the total interest you pay over time. Additionally, interest on home equity loans is only tax-deductible if the funds are used to substantially improve the home, according to IRS rules, so using the loan for other purposes may not provide any tax benefit. Always calculate the total repayment amount, including all fees and interest, before committing. Look at the annual percentage rate, not just the interest rate, and compare offers from multiple lenders to ensure you understand the true cost. Avoid variable rate risk without understanding how payments can change. Home equity lines of credit, or HELOCs, often come with variable interest rates that are tied to benchmarks like the prime rate. While these rates may start lower than fixed-rate loans, they can increase over time, sometimes significantly, For example, a HELOC with a starting rate of 6% could rise to 9% or higher if interest rates increase. On a $75,000 balance, that change could raise your monthly interest payment by several $100s. Many borrowers underestimate how quickly these adjustments can happen and how they impact cash flow. Additionally, HELOCs often have a draw period, typically 5 to 10 years, where you may only be required to make interest-only payments. Once the repayment period begins, your payments can jump sharply because you are now paying both principal and interest over a shorter time frame. This payment shock can strain your budget if you are not prepared. To avoid this mistake, model worst-case scenarios by calculating what your payment would be if rates rise by 2% to 3%. Make sure your budget can handle those higher payments before choosing a variable rate product. If stability is more important to you, consider a fixed-rate home equity loan instead. Avoid putting your home at risk without a clear repayment plan. A home equity loan is secured by your property, which means failure to repay can ultimately lead to foreclosure. This is what makes it fundamentally different from unsecured debt like credit cards or personal loans. Before taking on this type of loan, you need a well-defined strategy for how you will repay it, including timelines, monthly payment targets, and contingency plans. For example, if you are consolidating $30,000 of credit card debt into a home equity loan at 7%, your new monthly payment might be around $350 over 10 years. That may seem manageable, but if you continue using credit cards and build up new balances, you could end up with both the home equity loan and renewed high-interest debt, doubling your financial strain. Similarly, if your income is variable or uncertain, you need to consider how you would continue making payments during a downturn. A good rule is to ensure your total housing costs, including your mortgage and home equity loan, do not exceed 28% to 30% of your gross monthly income. Build an emergency fund with at least 3 to 6 months of expenses before borrowing. Treat the loan as a serious long-term obligation, not a quick financial fix, because your home is the collateral and the consequences of default are severe.